The Strait of Hormuz is effectively under a dual blockade. Oil is at 110, and Iraq's exports have collapsed by 89%. This isn't a routine weekend headline. It's a physical flow crisis that will hit the Monday open with massive force. Iran is charging tolls. The US is applying naval pressure, and the UN is paralyzed by vetoes. If you're holding oil, gold, or Indian equities, your plan for Monday needs to be ready right now. Let's get into the data. Welcome back to Yearn to Grow. This channel is about understanding finance and insurance clearly and calmly. No pressure, no shortcuts, just clarity. Today, we break down the Hormuz crisis and the Monday market map. Today is a weekend day. On the public calendar, there is no fixed meeting schedule between Washington and Tehran. There is no press conference scheduled to calm the nerves. We are in a news vacuum where headlines move futures. The UN Security Council has no confirmed vote time locked in. The diplomacy is happening in the shadows, while the market reacts to shipping rules and real flow disruption. Tomorrow will be the same. Quiet on data, loud on headlines. This isn't just political talk, it's physical. Over 1,500 vessels are currently stranded. Mariners are trapped. The world's energy artery is being squeezed, and the insurance companies are the ones sounding the alarm. Here is the situation in one line. Iran is controlling access with conditions. The US is applying pressure through its own blockade policy. China wants the strait open with no tolls. And the UN route? It's completely stuck. The UN is gridlocked because China and Russia are expected to veto any US-backed approach. They've already called the current draft unbalanced. There is no international consensus on how to reopen the gates. Tehran's message is blunt: zero trust in the United States. Iran's foreign minister says negotiations only happen if Washington is serious. This isn't diplomacy. It's a high-stakes standoff under maximum pressure. The talks are now conditional bargaining. Iran is treating the strait as private property. They've stated vessels can only pass if they coordinate with the Navy and are not at war with Iran. The free passage era is on hold. Let's look at the math of the Hormuz tolls. Iran is reportedly charging over $1 million per vessel. With hundreds of ships trapped, that's hundreds of millions in extortion revenue that bypasses standard banking. It's a shadow economy at the mouth of the Gulf. Why is China so quiet? Because they've been filling their strategic reserves for years. They have 90 days of cover. They can afford to let the US and Iran grind each other down while they wait for the cheapest entry point to mediate. Information is power. For India, every $10 jump in oil drains billions from the forex reserves. At 96 per dollar, the RBI is burning through cash to defend the rupee. This isn't sustainable. The stress on the Indian banking system is growing with every minute the strait is blocked. Project Freedom escorts aren't a guarantee of safety. They are a guarantee of visibility. A tanker under escort is a stationary target if Iran decides to escalate. One sea mine or one drone hit, and the project becomes a full-scale kinetic engagement. You are trading on a razor's edge. The Iraq-Ceyhan pipeline is a bottleneck in itself. Even at its theoretical max of 500,000 barrels, it can't move what the bus reports can. It's like trying to drain a swimming pool with a straw. The market knows this math, and that's why prices stay high. Distinguish between geopolitical risk and flow premium. Risk is what might happen. Premium is what is already missing. We are currently in a flow premium market. The oil isn't missing because of fear. It's missing because of a physical blockade. That premium doesn't fade with a tweet. The NSE gold receipts are highly efficient. There's no GST when trading on the exchange. You only pay the 3% GST if you choose physical redemption. This makes it the most tax-efficient way to play gold in the Indian market. Purity is 99.9, guaranteed by SEBI. The aviation sector in India is in a pain zone. Jet fuel is the single largest cost. With oil at 110, ticket prices must rise, but that kills demand. It's a lose-lose scenario for Indian carriers. Watch the aviation stocks on Monday for the first signs of capitulation. Use the weekend silence as your shield. If you aren't hedged by Sunday night, you are gambling. The market open is when the professionals execute their weekend plans. If you are reading the news at the open, you are already too late. Have your levels ready. The US-Bahrain resolution demands that Iran disclose the locations of all sea mines and stop the tolling. It's a direct challenge to Tehran's naval sovereignty. If it passes, it's a mandate for force. If it fails, it's a green light for more tolls. There is no middle ground. The market reaction was instant. Higher risk, higher insurance costs, and a longer timeline for any return to normalcy. When insurance companies stop covering tankers, the oil stops moving regardless of what politicians say. Trump claims President Xi agrees the strait must reopen. China is more careful. They don't want tolls or militarized restrictions on global trade routes, but they aren't ready to back a US resolution yet. Their interests are aligned only on no tolls. China's public messaging is a strategic silence. They've criticized the US-Bahrain draft resolution as ill-timed. They know the crisis hurts them, but they won't help the US consolidate power in the Gulf. They are playing for a different endgame. The most damning data point comes from Iraq. Exports through Hormuz collapsed from 93 million barrels a month to just 10 million in April. That is an 89% drop. The physical flow problem is real, and it is catastrophic. This proves the crisis is physical, not political. Iraq's oil minister admitted insurance issues are deterring tankers. When the ships don't come, the oil stays in the ground. That's why the market stays tight even when no one is shooting. On May 4th, the US launched Project Freedom, naval escorts for merchant vessels. But Iran considers this a violation of the fragile truce. Every escort is a potential trigger for a new escalation. This is the naval chessboard. Iraq is desperately trying to scale the Kirkuk-Ceyhan pipeline. They've reached 200,000 barrels a day with a goal of 500,000. It's a lifeline, but it doesn't replace the 3 million barrels a day lost from the Gulf. So the real state for May 26 is this. No full war breakout today, but the strait remains constrained and the rules are contested. The risk premium isn't just alive, it's being reinforced by every day the tankers stay anchored. The only drivers today are the after effects of the Trump-Xi talks. Tomorrow is when the rules of passage or toll headlines usually drop. Watch for weekend shocks. If the headlines are calm, we hold. If they are aggressive, we gap. Sunday night is when the futures market reacts to the weekend's silence or noise. If Tehran announces a strict toll enforcement, oil will gap before the first bell in Asia. You cannot afford to wait for Monday's open to have a plan. Monday brings standard macro data, housing sentiment, and capital flows. They don't change the Iran story, but they move the dollar and yields. And in this environment, the dollar is a direct weight on gold's shoulders. The loop is simple. Oil-driven inflation keeps yields supported. High yields make the dollar stronger. A strong dollar makes gold more expensive for everyone else. Unless there is a massive risk-off shock, the macro trend is heavy for gold. In India, the big story is the launch of electronic gold receipts on the National Stock Exchange this Monday. This is a modernization of how India buys and holds gold. No more fragmented pricing, it's one nation, one price. These receipts represent physical gold stored in SEBI-regulated vaults. You can trade as little as 100 milligrams. It's liquid, transparent, and you can redeem it for actual gold bars if you choose. This will change Indian gold liquidity forever. For Indian investors, this removes the storage and purity risk of physical gold. With T+1 settlement, it's as liquid as a blue-chip stock. If you've been sitting on physical gold, the NSE just gave you a way to move into the capital markets. Now, the market plan for Monday. Oil is the leader. Brent ended the week at 109, WTI at 105. The bias is buy the dip. Why? Because the flow problem hasn't been solved. The constraint is the structure. Your first support zone for Brent is 108. If Brent holds this early Monday, it means the bulls are still defending the risk premium. If we stay above 108, the trend is intact and looking higher. The second support is 105. If Brent falls into this zone and stays there, the market is starting to remove the war premium. It signals a shift in the narrative toward de-escalation, even if it's just a temporary pause. The 100 level is your line in the sand. If Brent loses 100 and stays below it, the bullish bias is dead. The market will have fully priced in a reopening, and the risk premium will vanish overnight. Watch this level above all else. Upside, we have resistance at 110. To break through to 112 and into the mid-teens, we need a fresh catalyst. A weekend incident, a shipping seizure, or a clear failure in the UN talks. No catalyst, no breakout. For WTI, support is at 104 and then 102. Like Brent, WTI has its own line in the sand at 100. If WTI is below 100, the American crude bull run is over. Adjust your size accordingly. A gap up happens if Iran announces toll enforcement or a shipping incident occurs this weekend. A gap down only happens if we see credible evidence of tankers moving freely without fear. Statements won't gap the market, physical flow will. Gold bias for Monday is sell the rally. It traded in the low 4,600s as yields pushed higher. Unless we get a massive risk-off shock, gold is fighting a losing battle against the dollar and interest rates. First support is the low 4,600s. If that breaks, we drift to the mid 4,500s. Buyers are defending here, but they are losing strength as yields remain sticky. The pressure is on the downside. Upside resistance is heavy at the high 4,600s into very low 4,700s. If gold can't reclaim this area early, rallies are meant to be sold. Don't chase the bounce unless the Iran news turns nuclear. What flips gold bullish? A major escalation shock that forces global risk-off positioning, hard, or a sharp cooling in yields and the dollar. Without those, gold stays heavy and continues its drift into deeper support levels. India is the primary casualty of this oil-rupee channel. Oil at 110 is toxic for the rupee, which is already at record lows beyond 96. This feeds directly into inflation and drains India's foreign exchange reserves. The 3 rupee fuel hike is a band-aid. OMCs are losing 500 crore every single day. Analysts say we need another 10 rupee hike just to break even. This is a massive fiscal drag that hasn't been fully priced by the stock market yet. Oil marketing company shares are weak for a reason. The price hikes aren't enough to offset the under-recoveries. Until oil cools below 100, these stocks are in a pain zone. The math simply doesn't work for the bulls right now. The Modi work-from-home appeal is about one thing: currency defense. By cutting avoidable fuel use, the government is trying to slow the dollar outflow. It's not a mandate, but it's a clear signal of the stress the economy is under. Expect volatility in fuel-sensitive and import cost-sensitive sectors this Monday. Logistics, aviation, and paints will feel the squeeze. Relief only comes if oil holds closer to the 100 zone and the rupee stabilizes. India gets relief quickly if oil breaks the 100 level. That would stabilize the rupee and lower the inflation fear that is keeping the RBI in a corner. Until then, Indian equities are a defensive play. Stay cautious on the open. The maritime state is a dual blockade. Iran has laid mines and is charging tolls. The US is blockading Iranian ports. It's a stalemate that has stranded over 1,500 vessels. This is the definition of a structural disruption. Iran's tolling is illegal under international law, but it's being enforced by the Navy. Some ships are reportedly being charged over $1 million just to pass. This cost is being passed directly to the consumer and the oil market. Diplomacy at the UN has failed. China's ambassador says the US resolution is unbalanced. This means there is no short-term political fix. The market has to resolve this through physical force or a total capitulation. Don't bet on a UN miracle. Project Freedom is a high-risk gamble. Every convoy is a target for Iranian coastal batteries. If one tanker is hit while under US escort, the fragile truce ends and we go into a full-scale kinetic escalation. The stakes are maximum. Iraq is talking to OPEC to stabilize its output despite the blockade. They are targeting 5 million barrels a day capacity, but capacity doesn't matter if you can't ship it. The bottleneck is the strait, not the wells. Remember that. Let's run the Monday sequence. Oil, base case is buy the dip above the 105 to 108 support band. As long as the strait is constrained, the risk remains to the upside. 100 is your exit if the bull case fails. Gold, base case is sell the rally under 4,700. The dollar and yields are the primary drivers here. Until the macro trend cools, gold is a heavy trade. Watch the mid 4,500s for the next test. India. Expect volatility. The stress points are the rupee at record lows and the fiscal drag of fuel price adjustments. Indian equities are a defensive play while crude stays in the triple digits. Look for currency stability as the first relief signal. In markets like this, risk management is more important than your price target. The headlines can gap the market 20% in seconds. Size your positions for the volatility, not the profit. Be disciplined or the market will do it for you. The NSE Gold Receipts launch is a generational shift for Indian liquidity. It integrates gold into the mainstream capital markets. This is how you hedge the rupee risk without the headaches of physical storage. Monday is day 1. Watch the volume. If you want physical gold, you can redeem your EGRs. SEBI-regulated vaults ensure the purity and security. This is the cleanest way to own gold in India. The transparency of exchange pricing removes the middleman and the markup. The crisis is simple. Trust is broken and flow is stopped. Until one of those changes, the risk premium in oil stays alive and the pressure on India stays high. Watch the physical data, not the political statements. That's the clean plan. Your final strategy check: Brent support at 108, gold resistance at 4,700, India Forex stress at 96, and NSE gold receipt volumes. If this explanation helped you see things a little more clearly, that is exactly what this channel is meant for. We will continue breaking down finance and insurance concepts step by step in a way that feels practical and manageable. If you find this helpful, please like the video, subscribe to the channel, turn on notifications so you do not miss future videos.